just to ensure, friends, that all of you have an in-depth understanding of the valuation. Let me begin this session with some of the very fundamental things about the valuation. So one is, what is value? Value, friends, in very simple words, is nothing but utility of an asset. An object that has a utility, it has a value. If an object has no utility, it has no value. What is valuation? Valuation is nothing but quantification of utility of an asset in money terms is valuation. Very simple definition of valuation. Why valuation? Why do we do valuation? We do valuation because we have to take a decision. So valuation is a very important tool in the hands of the people, in the hands of the corporate for decision making. What we find through valuation, what we find through valuation is very simple. We find the fair value. So whenever anyone is indulging, anyone is engaged in doing the evaluation, what is he trying to find out? He is trying to find out as to what is the fair value of that asset or that liability. What are the premises of valuation? So please remember, there are only two premises of valuation. Number one, it is known as going concern. Going concern. So one premise of the valuation is going concern. The second premise of the valuation is liquidation. Now, what is the meaning of premise? So premise would simply mean that whenever you are trying to do valuation, what is the basis on which you are proceeding? So invariably, in most of the cases, whenever you are doing valuation, you will have two premises. Primarily, fundamentally, you will have two premises. Either you will have the premise of liquidation, that means the company for which you are doing valuation is going in for liquidation, that company is going to close down. Or you will or the second premise that you will have is going concern. That means the entity for which you are trying to do the valuation, that entity is going to be in the business for all times to come, and therefore you want to do the valuation of that entity as a going concern. What is business valuation process? We will understand it now, and how to do valuation also we will understand now. Now friends, please remember, all that which I have discussed with you just now is applicable in respect of all the assets. Whether you are looking at the valuation of land and building, or you are looking at the valuation of plant and machinery, or you are looking at the valuation of securities or financial assets. So whatever I have discussed with you with regard to value, valuation, why valuation, and what we try to find out through the valuation, what are the premises of valuation, it is applicable in respect of all kinds of the assets. Now, I'm aware that all of you are at the threshold of entering into the profession. All of you have just completed your company secretary's course, and you will now be becoming member of our institute, and thereafter you will either be joining the industry or you will be joining into practice. So when you join into practice, you have the option of simultaneously also practice the profession of valuation, but it is subject to you having requisite experience, which in case of the company secretaries or chartered accountant or cost accountant, the post qualification experience got to be 3 years. That means you can become a formally a valuation professional only after you have post qualification experience of 3 years. But you can start your journey of the valuation right from now. So you do not have to wait for 3 years. You can start your journey of getting good understanding and grasp and hold into valuation right from now. For that, my recommendation would be, you must start your journey in valuation with a good understanding of IND-AS 113, which is on fair value measurement, and then you should simultaneously also have a good understanding of international valuation standards issued either by the International Valuation Committee of International Valuation Standards Committee, IVSC, or the valuation standards issued by the Chartered Accountant Institute of Chartered Accountants of India. So you must go through these valuation standards so as to get a good grounding. Incidentally, everything that we are discussing in this program is based on the valuation standards as encapsulated in the IVSC standards or the ICAI standards. So this is what you should do so as to have a good grounding in the valuation. Now let me give you quick understanding of the Ind AS 113, which is on fair value measurement. Number one, please remember, Ind AS 113 does not mandate any particular method or approach to be adopted by anyone who is doing valuation of any asset or any liability for that matter. So there is no particularly mandated method or approach by the Ind AS 113. Number two, the three approaches that are specified by the Ind AS 113. One is income approach, second is the market approach, and third is the cost approach. At this juncture, let me tell you as to why income approach is known as income approach, and why market approach is known as market approach, and why cost approach is known as a cost approach. No rocket science, is very simple. When you are trying to do the valuation using the income approach, or when you are trying to do valuation of an entity using income as the basis for the purpose of valuation, that is known as income approach. When you are using market information for arriving at value of any asset, that is why it is known as market approach. And when you are using the cost information about the cost of the assets or the liabilities, that is where it is known as cost approach. So these are the three approaches prescribed under Ind AS 113, also incorporated in the valuation standard issued by IVSC and also issued by ICAI. So these are the three approaches, and this is the reason as to why they are known by these names. I am sure, friends, this small thing that I have just discussed with you will make a lot of things easy for you as you proceed on your journey in the valuation. Number two, in the Ind AS 113 that you must know, that Ind AS 113 talks in terms of three levels of input. So one is level 1 input. And what is level 1 input? Very simple. It simply means when you are trying to do valuation of an entity, if that entity is listed on a stock exchange, then you must take the quoted price as the basis for the valuation of that entity. It is as simple as that. Number two, label input 2. So label input 2 talks about the observable inputs. So observable inputs, and that means what? That means in case the asset that you're trying to value is not listed on a stock exchange, that means quoted price is not available, you still have to do the valuation of this asset or this company. So how do you do the valuation? So the Ind AS 113 prescribes label 2 input. And what is the label 2 input? Label 2 input would mean that you try and find comparable company of the company of which valuation you are trying to do. So then the information about the comparable company becomes the basis for the purpose of valuation of the company that you are trying to value, which is not listed on a stock exchange. And that is what is your label 2 input. And then Ind AS 113 also talks about label 3 input. And what is the meaning of label 3 input? Label 3 input means that the company that you are trying to value, or the asset that you are trying to value, is not listed on a stock exchange, and therefore you do not have the quoted price available of that asset or that liability. Likewise, there is no comparable company or comparable asset available to you for arriving at the value of the target company that you are trying to value. So therefore, how do you do valuation in such a case? So the Ind AS 113 talks in terms of level 3 input. And what is the meaning of level 3 input? The meaning of level 3 input is if the quoted price is not available, if the comparative information is also not available, In that case, what you do, you try and do the evaluation based on the unobservable inputs. So what is the meaning of unobservable inputs? It simply means that you create your own information with regard to the entity which you want to do the evaluation of. And that is what is label 3 input. It simply means that you want to do the evaluation of company XYZ. Company XYZ is not listed on a stock exchange. Company XYZ also does not have a comparable company. But you still have to do the evaluation of this company. How do you do it? You simply prepare projected financials of this company, and based on the projected cash flow of this company, you try and find out the intrinsic value of this company, and that is what is the label 3 inputs, and which is prescribed by the Ind AS 113, which is on a fair value measurement. As I said, follow the evaluation standards for a comprehensive understanding of valuation framework and also for successful completion of valuation assignments, and that is what you should do. As I mentioned to you, there are 2 standards. Of course, there are many standards available on the evaluation world over. So, but we do not have to worry about all the standards which are issued in different geographies. We need to focus on 1 or 2 valuations, and the 1 or 2 valuations that we can focus on, one is the valuation issued by the Institute of Chartered Accountants of India, and the other one is issued by the International Valuation Standards Committee, IVSC. So you can just pick up them. Just to give you an information, the difference between the IVSC standards and ICAI standards primarily is on account of that IVSC standards include standards on the valuation of plant and machinery and land and building and other real property, whereas ICAI standards, obviously because it is a standard issued by the Institute of Chartered Accountants of India, which are concerned more with the finance and accounts, and therefore the standards issued by ICAI do not incorporate standards on the plant and machinery and on the land and building, because these are not relevant for we people who are primarily valuation professional for the SFA, that is securities and financial assets. But otherwise you would see that both these standards are more or less on the same lines, and they have to be on same lines because if it is a standard, it has to be same, it cannot be different. What is the objective of valuation standards? So 3 prime objectives of the valuation standards. Number 1 is to enhance the reliability and accuracy of valuation. So this is the purpose which is achieved with the help of valuation standard. Number 2 is to ensure that valuation reports are standardized and transparent. And number 3, the purpose of valuation standard is to protect the interests of stakeholders by providing an objective assessment of asset values. So these are the the objective of the valuation standards. Now friends, let's come to the business valuation process, or what is the valuation process, how the valuation processes are carried out world over, and that is what we will understand now. So whenever anyone has to do valuation anywhere in the world, where do you start from? So firstly, you start from the purpose of the valuation, why you want to do the valuation. Then you identify premise of valuation, as we discussed little while ago. What is premise of valuation? Whether the valuation is to be done of an entity which is going to close down, that means liquidation premise, or valuation is to be done of an entity which is going to be in the business for all times to come, and that is the going concern premise. After that, you determine the standards of value. So basically there are 4 standards of value. Number 1 is fair value. Number 2 is the fair market value. Number 3 is the specific value. And number 4 is the intrinsic value. So you arrive at as to which valuation standards that you are looking for the purpose of the valuation that you are working on. After that, collection of information, data, and its analysis. Obviously, valuation is an exercise where you have to play with the numbers. So you need to compile all the numbers relating to that particular asset that which you are trying to value, and so collect those information, do the analysis of those information, and it is from the analysis of those numbers or those financials that you will arrive at the valuation. So that is collection of information is the important part of the valuation process. After that, selection of appropriate method of valuation. So based on what is the premise of the valuation, that based on the purpose for which you want to do the valuation, you would be able to figure out as to which method of the valuation you should use or which approach of the valuation you should use. And that's your fifth step in the process of valuation. And once you do this, last step is determination of value. So when you complete all these steps, you are able to arrive at the value of that particular asset or the liability which you are trying to value. Now, just to give you an idea as to what are the purposes for which valuation can be done. So at this point in time, friends, keep in your mind, valuation is a very important tool in the hands of the corporate for the purpose of arriving decisions. Rather, and please remember this, rather it is next to impossible for any corporate to take any decision without doing valuation. So valuation, remember, is in the base of any decision which is taken by any corporate anywhere in the world. Without valuation, decision is just not possible. Only difference is sometimes you can do the valuation on a piece of paper or in computer. Sometimes you can do the valuation only in your mind. But valuation you have to do for the purpose of arriving at the valuation. So what are the purposes for which valuations are done all over the globe? Number one is the transactions. So you have corporate structuring, mergers and amalgamation, buyback. So in all such cases, you will use valuation. Valuations are done for the purpose of compliance. So you have FEMA, transfer pricing, income tax, SEBI regulations. They prescribed many compliances, and so for fulfilling those compliances, valuation can be done. Valuation can also be done for financial reporting. So you have to do the impairment testing in the business. You have to do the purchase price allocation. So in case if you are doing a business combination, so India's 103 will on business combinations will require in case of the business combination, the purchase price need to be allocated on the assets which have been acquired by the acquirer. So for that purpose also you will need to do the valuation. Valuation can also be required for the purpose of fair value reporting as per IFRS, as per Ind AS, or as per the US GAAP. As a matter of fact, as per any GAAP anywhere in the world, you will require the valuation. Valuations are also done for the purpose of litigation. So there are cases of bankruptcy, shareholder dispute, marital dissolution, intellectual property dispute, and that's where again you will do the valuation. So these are different situations, friends, where the valuations are required. Please remember, primarily doesn't really matter as to whether you are taking a small decision or big decision. Whenever you are taking a decision, you have to do the evaluation, and that is the utility of valuation. And that is why I always say valuation is not merely an exercise in number. Valuation is much more than exercise. Valuation is a very important tool in the hands of the corporate for arriving at the decisions. Now let's look at what are the different approaches or methods for the purpose of valuation. So we have understood many things. We have understood all these 6 steps, and you will see that the 5th step here talks in terms of the selection of appropriate valuation approach. So what are the approaches or the methods of valuation? Let us now focus on them. So as we discussed, primarily there are 3 approaches of the valuation: income approach, market approach, or asset approach. Asset approach is also known as cost approach. So it doesn't really matter. Sometimes some people might refer it as cost approach. Sometimes they may refer it as asset approach. In both the cases, it means the same thing, no difference. Under the income approach, you will have two methods. One is known as income capitalization method and the other is discounted cash flow method. What is income capitalization method? Income capitalization method of the valuation is based on the past data of income. So under the income capitalization method, you will use the past profitability information of a company. Based on that, you will arrive at the value of that particular entity. Under the discounted approach, you do not use the past information about income of an entity. Rather, you prepare projected income or projected cash flow or projected financials of the entity which is with regard to the future, and based on the projected information or projected future cash flow, you take a decision. And why it is known as discounted cash flow method? It is simply because we understand that the value of money changes with the passage of time. A 100 rupee note in my hand today is not worth same as 100 rupee note in my hands 1 year down the line. Why? Because the value of 100 rupee note in my hands 1 year down the line would have gone down. So the money which I am receiving today or which I am going to receive from 1 year from hence or 2 year from hence is not going to be same in terms of value. And to make all these cash flows comparable, what we need to do, we need to discount these cash flows with a discounting factor. And what the discounting factor is, the discounting factor is nothing but it is cost of capital of the person on whose behalf you are taking a decision or on whose behalf you are doing the valuation. So that's your discounted cash flow method. Under the market approach, firstly what you have, as we discussed in the context of Ind AS 113, firstly what you have is the level 1 input, that is quoted price. And in case if the quoted price is not available, then you have other methods, and that is comparable company method. So that means, as I've discussed with you, so I'm not repeating, but just to tell it to you in brief. In case the company that I'm trying to value is not a listed one, then what I can do, I can find out if there is a comparable company which is listed on the stock exchange, and the quoted price of that company, they can then become basis for me to arrive at the value of the entity that I'm trying to value. So in case if you are doing valuation of a company, you will call it as comparable company method, CCM. Or in case if you are doing valuation not of a company but merely a transaction, in that case it will be referred as comparable transaction method. Thereafter, you have the cost approach and the asset approach. Under the cost approach and the asset approach, you have four methods. The first method is book value method. So what is book value method? Very simple. You want to do the valuation of XYZ, pick up the balance sheet of XYZ as of the latest date, and from the figure of the assets minus the figure of liabilities, what you get in your hands is the book value of that entity. So book value method simply means pick up the numbers as they are given in the books, that is in the balance sheet, use those numbers for the purpose of arriving value, and that is your book value method. Number two is adjusted book value method. So what is adjusted book value method? No rocket science, very simple. Sometimes it happens in case of companies, not sometimes, all the time I would say. Company XYZ purchased a land 20 years back for 1 crore. Today, the market value of that land is 50 crores. So today, if somebody has to do the valuation of XYZ Limited, what he should do? Should he take the value of the land as 1 crore or should he take the value of that land as 50 crore? So the answer, of course, is he should take value of that land as 50 crore. So what you are doing, you are adjusting the value of the land from 1 crore to 50 crore, and that is why this method is known as adjusted book value method. Pick up the balance sheet, all the items which are appearing in the asset side and the liability side, analyze them, see and check whether the current market value of those assets which are given in the balance sheet, is it same at which they are reflecting in the balance sheet, or in reality those values have undergone a change. So if those values have undergone a change, what you need to do, you need to take the changed values, and that is why it is known as adjusted book value method. Thereafter, you have the replacement method. So replacement method means the asset that you're trying to value. So you need to do the value of that asset as in the current situation, not as replacement of this asset with a new asset. No, in the current situation, whatever the current situation of that asset is, you need to find out the value, and that is your replacement method. And fourthly and finally, it is liquidation value method. So what is liquidation value method? That this company is under distress, this company is under forced sale, it has to be sold, there is no other option available. So if this company is, the assets of this company are sold today, how much money one would realize, and from that what you do, what are the liabilities that you will need to pay. So you minus from the money that you will realize from the sale of the assets, minus from that value the liabilities that you have, minus from that value the expenses that you will incur on the sale of those assets. After that, whatever money is left, from that money you minus the liabilities that you have to pay. Now this is your liquidation value. Now friends, as I have discussed with you already, the valuation hierarchy, just to give you a context about that. So this quoted price is your level 1 input, the comparable information is your level 2 input, and discounted cash flow becomes the level 3 input. So this is how the Ind AS 113 on fair value measurement will work in case of valuation. Just to give you some more idea, I am sure as the fresh company secretaries, some question must be coming into your mind as to which method to depend on, which method to rely on for the purpose of doing valuation. So I would say income approach, in my view, is most fundamental, dependable and reliable. Ignore it at your own risk. So whenever you want to do the valuation, I always very strongly recommend and suggest and use the discounted cash flow method. I would not use income capitalization method also as much as I would use the discounted cash flow method. And why would I use the discounted cash flow method? And that is because ultimately, what is the utility of an entity? Utility of an entity is its ability to generate cash. So if I have to do the valuation of this entity, what should I use as the basic information? That is the cash flow. So the discounted cash flow method is the most fundamental. The market approach is also useful, but remember, market approach should be used as a cross check. So you have arrived at the valuation of an entity based on the discounted cash flow, then you can cross check it with the market information, or vice versa. That means if an entity is listed on a stock exchange and you are getting X value of that entity, try and also find out the discounted cash flow value of this entity, so as to have the confidence about the valuation. As regards the cost approach or the asset approach, as we have understood, it is mostly used in case of liquidation, and it only gives you the downside value of an asset. So these are friends are the methods, and this is how you do the valuation. This is how we do the valuation. Now, a question that may be coming into your mind as to where the discounted cash flow method can be used. So I would say, friends, in very simple words, any asset that has the capability of independently generating cash flow, all such assets can be valued using the discounted cash flow method. Just to give you a little broader idea, there are classes of valuation and classes of assets. So there are primarily 3 classes of assets which are identified in the valuation rules of 2017. So the first one is securities or financial assets, is the first class of assets. Second is the land and building, and the third is the plant and machinery. So these are the 3 classes of the assets. As we all are concerned primarily with the SFAs, securities or financial assets, So under this category of securities and financial assets, we can do the valuation of businesses and equity. We can do the valuation of intangible assets. We can do the valuation of fixed income securities. So what is the meaning of fixed income securities? That means all the investments that you make in different instruments, whether debenture or preference share or any other instrument, whether where you are going to get a fixed rate of return. So that is, those are known as fixed income securities. So we can do the valuation as registered valuer for the securities and financial assets of fixed income securities. We can do the valuation of derivatives. So we can do the valuation for the options as required under the IFRS or under the Ind AS or under the US GAAP or under any other GAAP as applicable in different geographies of the world. And we can also do the valuation of the other financial assets and liabilities. So this is, friends, just to give you an idea. Number one, DCF, discounted cash flow method, can be used in respect of any asset which has got the capability of generating independent cash flow. Now, as per the curriculum that we have, we move to the second topic, and the second topic is techniques of different types of restructuring and importance of valuation. As I said in the beginning, and I'm sure you would remember, any corporate decision that you take, valuation is always in the base of it. So let us understand as to how the valuation is in the base of different kinds of techniques of restructuring which are practiced by the corporates all over the world. In other words, what we are saying is, what is restructuring and why companies resort to restructuring in the first place, and then we will also look at as to how the valuation is used for the purpose of taking those decisions. Right. So friends, doesn't really matter in which company you are, in which industry you are, what is your product, what is your service, which is your geography, what is the constitution of your company, whether you are a government company or a private company, whether you are in infrastructure industry or FMCG industry or any other industry, whether you are a private limited company or a public limited company, whether you are a partnership company or a proprietorship firm, doesn't really matter. Doesn't really matter. All the businesses all over the world are driven by four things, and what those four things are, number one is the value creation. Number one is the value creation. So दुनिया के जितने भी businesses हैं, all those businesses are primarily focusing all the time as to how to maximize the value creation. So for maximizing value creation, what the businesses world over do, number one, they are constantly working on EBITDA. How to maximize the EBITDA. And number two, they are also working on how to maximize the operating free cash flows. Number three, they are constantly working on how to improve the return on capital employed. And number four, they are constantly working on how to improve the economic value added by a business. So all the businesses all over the world, irrespective of the industry, irrespective of the product, irrespective of the constitution, are constantly working on maximizing the value creation. And for maximizing the value creation, what they are doing, they are constantly working on improving the EBITDA, operating free cash flow, return on capital employed, and finally economic value added. So for this purpose, what are the different forms of restructuring, corporate restructuring used by the corporates all over the world? So number one is merger and amalgamation. So the question is merger of a company based in India possible with an overseas company? And today answer, of course, is yes. So the Companies Act 2013 provides for overseas mergers and acquisitions. So a company in India can acquire a company outside India. A company outside India can acquire a company in India. And the mergers also can happen of a company in India and outside India and vice versa. And there are many examples of such kind. One of them is Brook Bond and Lipton tea. Right, Brook Bond and Lipton tea. Then absorption. So in case of merger, what happens? In case of merger, two entities merge and a third entity comes into existence. That is generally referred as merger and amalgamation. By the way, friends, constantly and permanently, there is always a confusion in all these terms which are used colloquially all over the world without any standard definition of them. But that this is how we need to understand. So then you have absorption. So in case of absorption, what happens? One company is absorbed by another company. That is your absorption. So you had a company called Tomco that was owned by Tatas, and this company got merged into Hindustan Unilever at that time. So that is an example of absorption. Then you have takeover or tender offer. So a local example of takeover, there are plenty of them. I'm sure you would know thousands of them, but just to keep the context alive with us. So you got a Consolidated Coffee getting taken over by Tata Tea. Globally also there are many examples that I'm sure all of you are aware, and we need not spend so much of time on that. Asset acquisition. So the example is Hindustan Unilever acquiring Lakme as a brand. So this is an example of asset acquisition, which is again a form of corporate restructuring. Restructuring can also be done of strategic stake. So ArcelorMittal acquired a stake in Uttam Galva Steel. Of course, finally, Uttam Galva Steel merged into ArcelorMittal. But at first stage, it was only about 10-12 years back that ArcelorMittal acquired, I think, 30% stake in Uttam Galva, which is a company based in Maharashtra. Then the buyback of shares again is an example of corporate restructuring. And why should a company buy back its own shares? There are hundreds of reasons. One reason is, and which is a prime reason, that through the process of buyback, promoters are able to increase their stake proportionately in the entity without shelling out even a single rupee from their pocket. So that is one reason as to why companies do the buyback. Second reason, of course, which is also an enabler, a company would do a buyback only when this company is sitting on cash. Unless and until you have cash pile with you, you will not be able to do a buyback, and it is not advisable also to do a buyback. And the example of the buyback, I'm sure all of you must be aware, because these three companies, that is TCS, Wipro and Infosys, in last few years have done multiple rounds of buyback. And the reason behind was that all these three companies were sitting on a huge pile of cash, and that is why they resorted to buyback. So buyback is another form of restructuring. Divestment or divestiture. So privatization by the government. So I'm sure you will know BSNL, with that company that earlier belonged to the government of India. It was sold to Tatas, which later on became Tata Communication. And I think subsequently, again, the name of this company has undergone a change. Hindustan Zinc, again a company that belonged to the government, was sold to Vedanta Group of Anil Agarwal. So these are the examples of divestment or divestiture. Friends, just to tell you at this point in time, what is the meaning of corporate restructuring? Very simple. So when you are changing structure of a company, that is referred as corporate restructuring. So whenever there is a change in the balance sheet of a company, the items that are appearing in the balance sheet of a company, more so the equity, debt, and the assets, long-term debt, long-term sources of capital, and the long-term sources. So whenever there are changes in the long-term sources of capital and the long-term application or the long-term assets, whenever there is change in these two components of an entity, that is, simply speaking, is corporate restructuring, because you are changing the structure of a company. So then you have joint ventures. So joint ventures again is a corporate restructuring. So there is a Tata belongs Tata. Tatas are into automobiles. Fiat is also into automobiles. Primarily they are competitors to each other, but then Tatas and Fiat entered into a joint venture for a specific purpose. And joint venture between the Piaggio and Greaves, joint venture between the ArcelorMittal and Sumitomo Steel of Japan is again an example of a joint venture. And likewise, DCM Group entering into joint venture with Daewoo Motors. So these are some of the forms of corporate restructuring, but not all. We still have many. Another example of corporate restructuring is slump sale or the asset sale. So, slump sale or the asset sale is something like demerger, but it is not demerger. Why? Because in case of demerger, you have to go to the NCLT. But in case of slump sale, you do not have to go to the court, or you do not have to go to the NCLT. Slump sale can be done, can be achieved by merely signing of a contract or agreement between the acquiring company and the acquired company. So this is how it can be done. So slump sale and the asset sale. Then you have a demerger. So examples of demergers that I can quickly give you is L&T's demerger and a resulting company called Ultratech is an example of demerger. Reliance demerging into 4 companies, and I'm sure you would remember when Dhirubhai Ambani passed away. 2 sons of Dhirubhai Ambani have differences, and therefore they decided to part ways. And for that purpose, the Reliance Industries as a company was demerged into 4 different entities, and those 4 different entities then shared by the 2 brothers. So that is an example of demerger. That is where you go to the court, and through the court, and now then it was court, but now it is NCLT. Through the NCLT, you divide the company into different parts strategically. And in case of demerger, what happens? The shareholders of the original company are also shareholders into the new entities which are getting demerged. So that's an example. Likewise, recent example is of Reliance and Geofinance. I'm sure you would know that Geofinance got demerged from the Reliance as such. I'm told that Vedanta Group is also currently in the process of demerging, and I understand about through this process of demerger, 5-6 new entities are going to emerge through the process of demerger. Demerger globally is considered to be a very good tool of unlocking wealth for the shareholders. Then you have equity carve out. So offer share of subsidiary to public through IPO, that is equity carve out. That is offer for sale. So example that comes to my mind is one of Endurance Limited and Elcam Limited. Just to give you an idea, Endurance Limited I think came out with an IPO about 7-8 years back. They not only came out with the IPO, simultaneously they also came out with offer for sale. And that time, as I would remember, the issue price was about 400 rupees. And today, after 8 years, 7-8 years, the current market price of Endurance as a company is about 8,000. Likewise, Elcam also did the same thing. So equity carve out is another form of restructuring. Spin-off is another example of restructuring. Split up, delisting is also a form of restructuring, and I'm sure many companies you would know. So Castrol India, Philips, SR Shipping, SR Ports, Alpha Lava. Now these are the examples. These are the companies which resorted for delisting. There are hundreds of such companies. I'm just giving you a few examples out of them. Leveraged buyout. So I'm sure all of you would know. There used to be a company called SR Steel. SR Steel belonged to Royas. Unfortunately, SR Steel's operations were not managed well. As a result of that, company had to go to NCLT because State Bank of India, the lenders of SR Steel, filed Section 7 of IBC petition with the NCLT, which was accepted. And finally, after a long drawn process, SR Steel changed hands and it was it was sold to a joint venture of ArcelorMittal Nippon Steel. So today, the erstwhile SR Steel is known as ArcelorMittal Nippon Steel, AMNS. So friends, these are the forms of different restructuring which are used globally for the purpose of maximizing the value. So I'm sure all of you would have got a message in your mind, in your thought process, कि in all these corporate restructuring, what is the driving force? What is the key weighing factor in all these decisions? And that is the swap ratio or the exchange ratio, right? So whenever any restructuring exercise is happening, someone is parting with the asset and someone is getting in return the cash or equity. So how do you decide the swap ratio? How do you decide the exchange ratio? So you will decide the swap ratio or the exchange ratio based on the valuation that you will arrive of the respective entities. And that is the friends importance of valuation in case of corporate restructuring. I'm sure, friends, a question must be coming in your mind as to, having understood and discussed what we have done so far, a question must be coming in your mind as to what are the opportunities available for all of us as valuation professional. I am sure as I am discussing with you or otherwise also, many of you would have already thought to become a valuation professional. And therefore, a natural question must be coming into your mind as to what are the opportunities available to us as valuation professional under the different statutes. Let me share that with you. Primarily, we all as valuation professional have the opportunities of valuation, or the valuation is required under different statutes. So the prime statutes that require valuation for different decision making is Companies Act and Income Tax Act, FEMA, and the SEBI regulations. So these are the four prime statutes that would require a valuation to be done. Now, who all can do valuation under these different statutes? So, as far as a registered valuer is concerned, now who is a registered valuer? Someone who has passed the valuation exam of IBBI, and having passed that exam has become a member of RVO, that is Registered Valuers Organization, RVO. That person is known as RV, Registered Valuer. So the registered valuer, as it stands today, can do the valuation that would be required under the Companies Act, and he can also do the valuation today that would be required as per the SEBI. SEBI, as I understand, is progressively asking all the valuations under different SEBI regulations to be done by the registered valuers only. So that is as far as the registered valuers are concerned. Then you have someone acting as a merchant banker. So the merchant banker today can do partly valuation for the income tax, and they can today do valuation under the FEMA, and they can also do the valuation under the SEBI regulations. And why under the SEBI regulations? Because most of the provisions under the FEMA would say valuation as accepted by SEBI, and SEBI would say valuation to be done by a registered valuer or a merchant banker. So that is how today a merchant banker will be able to do valuation for some of the things under the Income Tax Act, all the things under FEMA, and all the things under the SEBI also. If you are a chartered accountant, a practicing chartered accountant, of course, you cannot do valuation under the Companies Act, but you can partly do the valuation under the Income Tax Act. You can do valuation under the FEMA, because FEMA also would say chartered accountants can do the valuation. Today, as a chartered accountant, you cannot do the valuation under the SEBI regulations. SEBI regulations, chartered accountants today are not permitted to do the valuation. So, chartered accountants can do valuation under the FEMA, or they can do valuation partly for some of the requirements under the Income Tax Act. Unfortunately or incidentally, if I'm a company secretary or I'm a cost accountant, current things as it stands do not permit me to do valuation under any of these things. But remember, as a company secretary, if you have a 10 years of work experience, practice experience, or work experience, then you can opt in. So if you are a company secretary or a cost accountant or a chartered accountant or a management consultant dealing in finance, if you have those qualifications and 10 years of work experience, you can get yourself registered under Section 34AB of the Wealth Tax Act 1957. And that means if you are registered under Section 34AB, then you can do all the valuations that would be required under the Income Tax Act. So these, friends, are the opportunities as it stands today. But going forward, it is expected that all the evaluations under all these statutes will only be done by registered valuers. That means the people who are registered with the IBBI as registered valuers. But as a matter of fact, a bill was already passed about 4 years back was already circulated in 4 years back. Unfortunately, this bill did not see the light of the day, and therefore I think is completely has died down. But as the thought process of the government appears to be, sooner or later we will have a law in this country where all the evaluations under all these statutes will need to be done by one class of valuers, and those one class of valuers going to be the people who are registered with IBBI. Now, friends, let's move to next aspect, and that is important provisions relating to valuation under the Companies Act 2013, requiring valuation by a registered valuer. So as we discussed little while ago, all the valuations under the Companies Act need to be done by a registered valuer only. So if that be the case, who understands the Companies Act better than we company secretaries, right? And therefore, if I am a practicing company secretary and I'm also registered valuer, I only will be able to do the valuation under the Companies Act requirements. So I need to know what those requirements are as per the Companies Act. Let us understand them one by one. Now, before that, let's take a 2 minutes break, or I'm sure 3 minutes break quickly. So in case you want to have water or something, please do that. In 3 minutes, we will be back again. Right. So let's now understand which are the provisions under the Companies Act that would require valuation from a registered valuer. So first of all, there is a section 54(1)(d), and that is about issue of sweat equity shares. I'm sure all of you must have heard about it. So sweat equity shares are the shares which are issued to directors or employees or some other people who are giving to the company something by way of IPR, know-how, or value addition, or any value addition in any other form. So whenever any such valuation is to be done, whenever any such sweat equity shares are to be issued, the valuation will be required of the asset which is being acquired. Accordingly, this valuation can be done only by a registered valuer. Then under section 62(1)(c), issue of shares, convertible securities on preferential basis for cash or for consideration other than cash. So whenever a company is issuing shares or convertible securities on preferential basis, as per section 62(1)(c), this issuance of secure shares or convertible securities on preferential basis will require valuation of these securities by a registered valuer. Then section 67 subsection 3b, lending of money by a company to a trust settled for administration of share-based employee benefit schemes. So friends, we all know there is a SEBI regulations on share-based employee benefits 2021 regulation. This SEBI regulation on SBES share-based employee benefit schemes provides for administration of these employee benefit schemes by the trust, and these trusts which will administer the employee benefit schemes or the employee option schemes of the company can purchase shares of the company, and in not only they can purchase the shares of the company, they can also borrow money for purchasing shares of those company from the company. And as per section 67 3b, whenever the trust is taking loan for the purpose of administering the employee benefit scheme, such shares can be purchased or subscribed and will need to be valued by a registered valuer. Section 174 subsection 4 clause 6 talks about every audit committee shall, in accordance with the terms of preference specified in writing by the board, which shall inter alia include valuation of undertakings or assets of the company wherever it is necessary. So this is an obligation given to the audit committee of a company, that whenever there is a transaction in an asset of the entity, then audit committee needs to have the valuation done, and these valuation will need to be done only by registered valuers. Then you have section 192 subsection 2, non-cash transactions involving directors for acquiring assets from the company. So whenever, as according to section 192 subsection 2 of the Companies Act, whenever there is a transaction between the company and the directors for acquiring assets from the company, again for such transaction to happen, the assets which are being transferred or which are being acquired from the company by the directors of the company or vice versa, such transactions will first need to be valued by a registered valuer. Only thereafter the transaction can take place, and I'm sure you can understand what must be the reason behind putting this provision into the Companies Act. That is to ensure that the directors are not in a position or are not able to acquire any asset of the company at any price that they want, nor they are not able to sell any asset of theirs to the company at any price they want to sell it at. So that is why you have this provision of section 192 subsection 2 in the Companies Act. Then friends, chapter 15 of the Companies Act, that includes section 230 to 240, which deal with compromises, arrangement and amalgamation. So in case of compromise or arrangement between members or with the creditors or any class of them, a valuation report in respect of shares, property or assets, tangible or intangible, movable or immovable of the company is required to be valued by a valuer, registered valuer. And that is an encompassing provision that you have. So all the arrangements, compromises, amalgamations that will be executed as per section 230 to 240 of the Companies Act. In all those transactions, the valuation required to be done by a registered valuer. Section 247 of the Companies Act, friend, is the in chapter 17 is the section that brings the concept of registered valuer first time in the Companies Act. So this concept of registered valuer was not there in the 1956 Companies Act. So the concept of registered valuer has come first time in the Companies Act in 2013, and that is by way of section 247. So number one, what this section 247 says. Number one, this section 247 stipulates the requirement and the situations where the valuation will need to be done, and by whom these valuations will need to be done. That is a registered valuer. Number two, it talks about as to who can be appointed as a valuer of in case whenever and wherever there is a requirement of valuation as per any of the applicable provisions of the Companies Act. So who can be appointed as a valuer and who cannot be appointed as a valuer. This section 247 also talks in terms of what are the responsibilities and the obligations of a registered valuer, and what are the penal provisions that will accrue in case if the valuer is not fulfilling his obligations as required under the section 247. Then you have section 260 subsection 2c, and that is management of affairs of corporate debtor by resolution professional. So really speaking, this section 260 subsection 2 clause c pertains to a matter under the IBC, and again section 260 subsection 2c prescribes that in respect of management of affairs of a corporate debtor by a resolution professional will require valuation. And I'm sure, friends, you can very easily foresee a situation, you can visualize, you can imagine whenever these valuations have been prescribed under the Companies Act. So whenever there's a transfer of an asset or a liability from the company to someone outside the company, it is in all such situations the valuation by a registered valuers have been prescribed under the Companies Act, primarily with a view to ensure that there is no undue benefits being passed on to the parties who have a vested interest. Section 262 section 262 deals with purchase of minority shareholding. So again, under different situations, if the shares of the minority holdings are to be acquired by the promoters, or if the minority shareholders wish to offer their shares to the promoter, in that case also sections 262 requires the valuation of the shares to be done by a registered valuer. Then you have section 281 subsection A, valuing assets for submission of report by liquidator in case of winding up order by NCLT. So in case NCLT has given an order for the winding up of a company as per section 281, then as per section 281 subsection 1 clause A, the assets which are being wound up or which are being sold as part of the liquidation order will again need to be valued by a registered valuer. Now friends, one thing that you must remember here, whenever I am saying registered valuer, it does not mean every time I am referring to a registered valuer for the securities and financial assets. No, when I say registered valuer, it would also include someone who is a valuer for land and building, or someone who is a valuer for plant and machinery. Why? Because all these situations that I am discussing with you as per the Companies Act, not every time will involve securities or the financial assets. In many cases, like in case of Section 281, when a company is being wound up, when the company is getting liquidated, so what is going to happen? What is going to be sold of this company which is getting liquidated? It is going to be plant and machinery and land and building. So therefore, or in case if this company also have some financial assets like investment in securities, in that case, even a registered valuer for securities and financial assets will also be required. But otherwise, a company which is getting liquidated will require more valuation by registered valuer for land and building and for plant and machinery. Section 305, subsection 2, clause D, declaration of solvency in case of proposal to wind up voluntarily, right? So if a company is deciding to go for winding up voluntarily under Section 305 of the Companies Act, then this company again will have to have the assets of the company with respect to declaration of insolvency to wind up voluntarily will need to be done by a registered valuer. Section 319 3B, final meeting and dissolution of company, valuation of shares to determine interest of the dissenting members. Rule 2C of companies acceptance of deposit rules also require valuation by a registered valuer. Likewise, Rule 8, Sub-Rule 6, 7, 8 and 9 of the company's share capital and debenture rules 2014 will require valuation by a registered valuer. So valuation for the purpose of issue of sweat equity shares that we discussed has got a compliance as per Rule 8, Sub-Rule 6, 7, 8 and 9 of the company's share capital and debenture rules 2014, and therefore this will again require valuation as per valuation from a registered valuer. Rule 12.5 of the Companies Act, prospectus and allotment of securities, Rule 2014, return of allotment. So again, report by a registered valuer in respect of valuation of consideration shall also be attached along with the contract as mentioned in Sub-Rule 3 and Sub-Rule 4. So Rule 12, Sub-Rule 5 of the company's prospectus and allotment securities Rule 2014 will require valuation. Rule 13, Sub-Rule 1 again of the company's share capital and debenture rules, issue of shares of preference capital. Of course, we have discussed this already, but now we are looking at from the perspective of the applicable rules. So earlier we discussed from the perspective of the section. Now we are discussing from the perspective of the applicable rules. So friends, these are all the requirements under the Companies Act and rules they are under that will require valuation to be done by registered valuers. Valuation to be done by registered valuers. Now we come to important provisions relating to valuations under the Insolvency and Bankruptcy Code 2016 requiring valuation of registered valuer. I am sure friends, all of you are fairly aware with regard to the IBC code, Insolvency and Bankruptcy Code 2016. Now what this code is and why this code has been brought into existence by the government of India, and that is because prior to the IBC 2016 in our country there were many laws relating to the bankruptcy and insolvency. Unfortunately, all those laws that we had in this country were not effective at all. As a result of that, the matters of insolvency and bankruptcy will keep on dragging in the courts of different level without any fruitful conclusion coming out. As a result of that, assets worth crores and crores of money or rupees were locked up, lying unused, getting wasted, getting damaged, getting lost, causing a deep damage to the economy of the country. And therefore, the government of India at that time thought of bringing out this new law, that is Insolvency and Bankruptcy Code 2016. This law has been brought with a twin purpose. What is the twin purpose? The twin purpose is, number one, if an asset is going through the insolvency, so the first purpose is to identify such companies which are passing through the insolvency and take these steps to revive these companies. And if the revival is not possible for whatever reason, then without wasting any further time, dispose of these companies, dispose of assets of these companies in a time-bound manner, so that if nothing else, these assets are bought by someone, and when the someone is buying these assets, he is able to use these assets in his business, plant and machinery, land building, into his business. Thereby, he is able to generate income for the economy of the nation. That is why he is able to improve the GDP. So the twin purpose was, number one, try and resolve the insolvency, make the companies operational and profitable. That was the first step. And second step was, if that is not possible, then close those companies, dispose of the assets, so that at least those assets starts contributing to the economy of the nation. So this is the law that is IBC, and of course I'm sure all of you must be aware in any case. So this law has got section 6, it has got section 7, section 8, section 9, section 10, and under these different sections, the creditors of the company can file a petition in the NCLT, or the employees of the company can file petition against the company in the NCLT, or the corporate debtor itself can file the application in the NCLT for the revival of the insolvency, for resolution of the insolvency of those companies. Now, so as to make realization of this objective of a revival or resolution of the insolvent companies or disposal of the assets, the IBBI, which is the chief regulator, keeps bringing out different regulations from time to time, very effectively, very rapidly, and so as to facilitate the process of insolvency resolution, and so as to facilitate the process of liquidation of a company in case company is going for compulsory liquidation. So what are the provisions under the IBC 2016? So under IBC 2016, number one, section 46. Section 46 talks about valuation of avoidable transactions under the IBC code. And what it says the adjudicating authority may require an independent expert to assess evidence relating to the value of the transactions. So when you will read IBC, you will realize that the IBC has a lot of provisions whereby the existing corporate debtor or the existing promoter or the existing management is prohibited from taking multiple steps whereby they are able to siphon the assets of the company in different modes. So to prohibit that, there is a restriction on which is referred as avoidable transaction. So avoidable transaction would mean a transaction which has been undertaken by the corporate debtor prior to the company becoming an NCLT company or IBC company. They have done these transactions not with a view to help the business, but to take care of their personal interest. So these are referred as avoidable transactions. And the educating authority in such cases can ask the registered valuer for doing the valuation of such cases. Section 59, which deals with voluntary liquidation. And voluntary liquidation, so liquidation in case of of the Companies Act can happen in two ways. Number one, the voluntary liquidation can happen as per section 59 of the companies of the IBC, or it can also happen as per the Companies Act. So with regard to section 59 of the IBC, which deals with voluntary liquidation, in case of voluntary liquidation proceedings, corporate debtors have to file a report of the valuation of the assets of the company with the application prepared by a registered valuer, right? So when a company is submitting an application under section 59 of the IBC, then while filing its application for the purpose of voluntary liquidation, the corporate debtor will also need to file together with the application a report by a registered valuer giving the valuation of assets of the company. That's your as per section 59, and that 59 is as per section 59 subsection 3b clause 2. Then you have a regulation 27 of IBBI insolvency, corporate insolvency resolution process 2016, and the regulation 27 of IBBI CIRP regulations 2016 talks in terms of appointment of two registered valuer. So what it says that as soon as per the order of NCLT, an interim resolution professional is appointed, or a resolution professional is appointed. Now within 7 days of his appointment, but not later than 47th day from the insolvency commencement, the IRP, interim resolution professional, or RP, resolution professional, they will appoint two registered valuers to determine the fair value of the business. And remember, they have to give the fair value of the business from two perspectives. Number one is the liquidation value, and number two is the fair value. So I'm sure you would recollect, fair value would mean valuation of the corporate as a going concern, and liquidation value would mean valuation of the corporate as a company which is closing down. Just to give you an idea, why does NCLT, or why the regulation 27 of IBBI CIRP regulation 2016 requires appointment of two registered valuers? And it requires appointment of two registered valuers because a company is going in for CIRP, corporate insolvency resolution process. So that means someone from outside will need to come and turn this company around. So if someone has to come from outside, he obviously will need information as to what is going to happen to this company in terms of value. So that is why there is a requirement as per regulation 27 for appointment of two registered valuers by the IRP or RP within 7 days of their appointment, but in any case not later than 47th day of their appointment. That is what they have to do. Then you have a regulation 35 again of corporate insolvency resolution process 2016 regulation. It talks about fair value and liquidation value. I have already explained to you why there is a requirement of fair value and why there is a requirement of liquidation value. So the requirement of the fair value and the liquidation value is, so anyone who is a resolution applicant. So who is a resolution applicant? A resolution applicant is a person or is a business house or is a corporate house which is interested in acquiring this company, which has gone to NCLT, and they would like to know as to what is the fair value. That means, as a going concern, what it is its value, and what is the liquidation value. That means, in case if the company is sold only asset by asset, then what will be its value. And that is what the two registered valuers, which are to be appointed by the interim resolution professional or the resolution professional, will give to the IRP or RP. Then as per the regulation 3(1)(b) 2 of voluntary liquidation process, so again there is a requirement of report of valuation and initiation of liquidation as per the regulation 3(1)(b) 2 of IBBI VLP 2017. Regulation 38(1)(c) 4 of IBBI VLP, final report prior to dissolution. So that requires to be submitted. Regulation 26 of the fast track. So please remember, in the IBC, not only you have the normal process of resolution, insolvency resolution, but you also have the fast track resolution. So what is fast track resolution? That means, in case of small companies, the normal period of 180 days, which finally increased to 330 days, was not applicable. In case of smaller companies could be fast tracked, and fast track would mean that their process of insolvency could be completed within a period of 90 days. So regulation 26 requires again appointment of registered valuers in case of fast track insolvency process as well. So right friends, so with this we come to the session of today, the first part of our session about the valuation and the related provisions under the different statutes, that is Income Tax Act, Companies Act, IBC Act, and today what we have done, and as per the IBBI regulation. So today what we have done, today we have covered number one as to what is the valuation per se, and what is the methodology, how the valuations are done, what are the approaches, what are the methods of doing valuation. Today we have also understood corporate restructuring and different techniques and different forms of corporate restructuring, and what is the significance of valuation in case of corporate restructuring, what role the valuation play in case of corporate restructuring. That is what we have understood. Then we have understood different provisions of the Companies Act that would require valuation to be done by the registered valuers, and I'm sure you would remember that there are many requirements of valuation to be done by registered valuers under the Companies Act. And so also we have understood under the IBC code, and also as per the regulations brought out by IBBI with regard to the resolution of insolvency of the corporates. So couple of things that I would like to, before we close the session today, couple of things that I would like to share with you. Number one, please remember what is value. Value is nothing but utility of an asset, and that is what you must remember. What is valuation? Valuation is quantification of utility of an asset in terms of money. That is what is valuation. Why do we do valuation? We do valuation because we have to take a decision. Remember, and I'm sure you can feel it, you can experience it, that no decision in the corporate world can ever be taken without any valuation. So valuation is something that has to be done. There is no choice. The only thing is, sometimes the valuation can be elaborate, sometimes the valuation can be in the minds of the decision maker, but the valuation has to be done in any case. We have understood the process of valuation. Where does it start from? It starts from the purpose of the purpose of the decision make purpose for which the valuation is to be done, and finally ending into determination of the value. We've understood today what are the different approaches for valuation. So the approach for the purpose of valuation, number one is the income approach, number two is the market approach, number three is the asset approach, which is also known as cost approach. Why do we call income approach as income approach? No rocket science. Income approach is known as income approach because when you are doing the valuation, the basis that you are using for the purpose of valuation is the income of that entity, and that is why it is known as income approach. Under the income approach, you can have two methods. You can have income capitalization method, which is based on the past income, or you can have discounted cash flow method, which is the future income, future cash flow, projected cash flows. Under the market approach, you can have number one is the quoted price, which is also label one input, or then you can have comparable methods. So comparable company method or comparable transaction method, which is labeled two input. Under the cost approach, you can have four methods. So you can have book value method, adjusted book value method, replacement method, and finally you can have liquidation method. So these are the three approaches and different methods for valuation used globally. Remember, we have to move forward by having a good understanding of India's 113, which is on fair value measurement, and also the valuation standards. So we can use the valuation standards prescribed or issued by the International Valuation Standards Committee, which is IVSC, or we can use the valuation standards issued by the Institute of Chartered Accountants of India. But in any case, whenever we are doing valuation, we have to follow either of these two standards. Incidentally, as I said in the beginning, these two standards are not very different. They're different only to the extent because international valuation standards are for a wider audience, whereas the standards, valuation standards brought out by the Institute of Chartered Accountants are only for the purpose of securities and financial assets. So the valuation standards issued by IVSC, International Valuation Standards Committee, inter alia will also include the standards on valuation of land and building, plant and machinery, and other assets. These three will not be there in the valuation standards issued by the Institute of Chartered Accountants of India. So friends, with this coverage, we can now sign off, and tomorrow when we meet, we are going to discuss the remaining part of it, which will include valuation as per the income tax. And I can tell you at this point in time, valuation as per the Income Tax Act is little more complicated than the valuation as per the Ind AS 113 or as per the valuation standards, because there you have standard methods to follow, whereas under the Income Tax Act there are different approach methods depending on the different situation. So there are a lot more complexities in case of valuations to be done under the Income Tax Act, but it would be my endeavor to explain the same to you in as simple words as possible. Tomorrow when we meet, we will also be discussing two more things, and those two more things are, number one, the valuation report, how to prepare the valuation report, what all should be forming part of the valuation report, how to make sure that the valuation report that you prepare is purposeful, is meaningful, and it is relevant, it is congruent. That is what we will discuss. And also tomorrow we will discuss the ethics part of it. See, there's a code of conduct prescribed for the valuers, which they are supposed to follow in every respect, because ultimately valuations are there for improving the level of corporate governance in this country, and that is what we will be discussing tomorrow in our session. So let me thank all of you once again and wish you all the very best. Let me tell you, as company secretaries, you are really privileged one, and use that privilege for improving well-being of everyone around you and everywhere. And that is what is good corporate governance is all about. Thank you so much and wish you great times. Thank you.